Central banks are buying gold at record levels, and dollar is under pressure, inflation is sticky, and geopolitical risks are rising. So what investors started doing was they started putting money in gold as a hedge against the uncertainty and the heavy monetary spending that was happening. Well, there's been global uncertainty, there's de-dollarization that's happening. From mid 2021 to mid 2022, Feds ended up increasing the overnight lending rate to curb inflation. That made money market funds that much more attractive. Global financial institutions continued to accumulate gold because there was a lot of uncertainty in the market. Now, let's talk about what many people are now calling the starting gun for the modern gold rush. And that was in 2022, the Russian sanctions that were placed by European Union, Canada, United States, and Japan. They actually froze $300 billion of Russian central bank's reserves. This is actually about countries starting to create a geopolitical insurance for themselves. So if this de-dollarization is happening, the question is US dollar at a risk of losing its global reserve currency status? And the short answer is no. For US to lose its global dominance of the USD will take decades. It's not happening anytime soon. Gold internationally is actually bought and sold in United States dollars. But I want to put that into perspective because some people may be thinking that, hey, USD has fallen down, so maybe this is the end of USD. No, guys, not really. Now, couple that with Russian assets being frozen and there are problems happening in the world, it's a perfect storm for gold to grow. So if US dollar continues its way upward from this point on, making US dollar stronger and stronger, well, guess what? That could become a friction point for gold from doing well. So where are we? We are actually in a crossroad. Dollar is still a dominant player in the world, but if and as it strengthens significantly, and I think it's going to strengthen from this point onwards, that can cap gold's momentum. But this setup is not going to last forever. Inflation, currency devaluation, or global crisis shift capital into other kinds of hard assets. So welcome everybody. Today's market update is all going to be about what's dominating in the headlines, which is gold. And that fits in perfectly with today's time frame as well, because Diwali is coming up and gold has just crossed $4,000 an ounce. And there is a mix of confusion, excitement, and speculation in the market. So with this Diwali special, I welcome you all. And without further ado, let's start discussing gold. Now, this isn't just about price action. There is a much deeper shift that's actually happening. Central banks are buying gold at record levels, and dollar is under pressure, inflation is sticky, and geopolitical risks are rising. So what does all that mean for gold, for stocks, and for you as long-term investors? So let's break that down step by step. What I have in front of me is the performance of gold since early 1920s all the way until now. And I'm going to show you how the gold prices move and how it gets affected by different things. So first of all, as you know, gold is a commodity that institutions and countries use as a hedge against uncertainty. And if you've been noticing here, the gold goes up and then it goes down, then goes up and goes down. But overall, the gold prices have been going up. So I want to talk about why it went up, when it went up, and then when it dipped, why did it dip? And then ultimately towards the end of the webinar today, I'm going to talk about what I think is going to happen to gold in the near future. So let's start with the time frame of just around 1920s. So notice at that time, what was happening was gold was being held by the United States government as a reserve for USD. So people could actually at that time swap a USD for gold at around the price of $20 per ounce. And also, people were not allowed to hoard gold. So that's why the gold was really pegged against the US dollar at the time. In 1933, so around this time frame, what happened was just after the Great Depression, United States needed to print much more money in terms of actual physical dollars. So they removed the requirement of holding gold in reserve for US dollars. And what this did was it immediately devalued United States dollar and it pushed the gold prices up. So gold immediately jumped up and it continued in that way. Then came the 1970s. So gold continued like this until 1970s, but then it jumped again. But what happened in 1970s was that US dollar was no longer backed by gold and currencies started floating freely. And this was also a time that basically allowed gold to move beyond $35 an ounce for the first time. Inflation at this time was rising because of the Vietnam War. And there was a lot of spending that was happening at that time. So, what investors started doing was they started putting money in gold as a hedge against the uncertainty and the heavy monetary spending that was happening. So, gold jumped at that time. And then came the time of 1981 to 82. Now, so what happened was after the initial panic, the realities sunk in the minds of investors, and the Feds also started tightening their monetary policies to basically curb the inflation that was going on at that time. And then money started rotating out of gold into the United States dollar. So when the inflation went up and the United States government started to increase their interest rates, that made United States dollars or the USD that much more powerful and stronger. So investors saw an opportunity back in the USD as a safe haven. So they took money gold and put it back into the United States dollars. Now that brought a dip in the gold prices and it dipped by about 45%. And it went from all the way from $180 to $100. So there was a dip immediately after that. But then from continued in 1970s to 80s, there was a perfect storm for gold. So gold started rising all over again. So what happened this time? Well, inflation at that time hit almost 14%. It was like 13 point some percent. So almost 14% in 1980s due to the oil shocks. There was also Iranian revolution happening at that time. There was a Soviet invasion in Afghanistan. And what this did was the US dollar started to weaken very sharply, and the interest rates also failed to keep up. So when that happened, again, investors found that US dollars was not strong. So they said, okay, let's put money in gold. So when they put money back in gold, then gold soared again. Now, when the gold soared, then in 1980 to 2000, it started to come down again. So what happened at this time was that because of this rising inflation, Feds raised interest rates. So remember, whenever inflation increases, one of the things the Federal Reserve tries to do is it increases the interest rates. And when they increase interest rates, remember the overnight lending goes up. And when the overnight lending goes up, the money market funds, they start to give you a better return. When people buy US treasuries, guess what? The demand for US dollar goes up. When the demand for US dollar goes up, well, US dollar starts to become more and more expensive. And that's where the money moves away from safe haven assets like gold into US dollars. So that strengthens the US dollar, but also starts to weaken the price of gold. And that's exactly what happened. From 1980s all the way to like early 2000s, the gold ended up dipping by 60%. So it did go down. But then something happened in the time 2001 to 2011. So first thing that happened was there was a dot-com bubble. So that dot-com bubble burst, then obviously the stock market got affected. But there were also 9/11 attacks in 2001. And then there was ultra low bond interest rates at that time. So when that happened, again, US dollar, their value was starting to go down, and investors again found a safe haven in the gold. So they put money in gold, and the gold prices start to go up. In 2008, the global financial crisis also had a major impact. Basically, it led to massive money printing and quantitative easing, which then led to some bank failures. And remember, quantitative easing through when you print a lot of money, it reduces the value of US dollars. So that again caused fears in the minds of investors, and they started pouring money back into gold, which again took gold into a rally. Then what happened? From 2012 to 2015, Feds started to taper the quantitative easing. Basically, they said that we're not going to have future rate hikes. So when the signaling started to happen like that, then the stronger US dollar and rising yields made US dollar and the US Treasury that much more attractive. And when they became attractive, then money again moved out of gold and went into the US treasuries, and the gold dropped by 40%. So this dip was a result of that. Then came the 2019 2020 COVID 19 pandemic. And what happened during that time is that the real interest rates started to fall. And again, that is a result of the interest rates that come as a result of the US Treasury. So when those real interest rates started to come down, guess what? Money moved back into gold and gold started to soar. And very recently, in 2023 to 2025, the inflation has been sticky. And how has that been sticky? Well, there's been global uncertainty, there's de-dollarization that's happening, and I'm going to discuss that very soon. Central banks started accumulating a whole lot of gold. And as they started accumulating gold, well, that started to increase the demand of gold. And when the demand of gold went up, well, the prices went up. So that's exactly why we have been noticing that the gold prices have been going up recently. Now, I want to zoom in over the last few years. So let's start from the 2021 and tell you what happened. So in 2021 to 2022, we know that the US inflation rose, and it rose to a whopping 9% by July 2022. And what that did was it brought equity markets to a correction phase, and gold at that time remained stagnant because the price of US dollar was still strong. But to curb this inflation, again, similar to what had happened in the past, United States Feds came in and said, well, let's increase the interest rates so the money supply goes down. Essentially, from mid 2021 to mid 2022, Feds ended up increasing the overnight lending rate, right? And when they increased the overnight lending rate to curb inflation, that made the money market funds that much more attractive. And when that happened, well, money moved into US bonds. And when money moves into US bonds or treasury bonds, guess what? Investments away from gold. And when investments went away from gold, well, at that time, check it out, the gold prices actually started to go down, right? But now something very interesting happened at this time. In February 2022, the Ukraine and Russia war had already started. Now, when that had started, the United States was trying very heavily to do whatever they can to make it difficult or expensive for Russia to carry on with that war. So they made a move. United States, European Union, United Kingdom, Canada, and Japan, they all got together and they coordinated sanctions to freeze their assets. And that assets was around the value of $300 billion, and that they were not necessarily just scattered in Russia, they were scattered all around. So they went and froze this money. And what this did was it basically sent shockwaves to other central banks into rethinking their reliance on US dominated reserves, because they're like, well, if US can come and these other countries can come and they can take our money and freeze it, and that money is no longer available to us, well, then maybe we need to stop our reliance on US dollar. So the only thing that these sanctions could not touch was money that was in Russia in their own banks, and second was gold. So they said, well, let's start putting money in gold. And this became the norm and also a wake up call for institutions around the world. So, institutions around the world at that time started hoarding gold. And I'm going to talk about how much that happened in the next slide, but essentially, it was almost like a ton a year, a ton of gold a year. Now, in mid 2022 to 2023, what happened was at this time, the rates had already been hiked. Due to those rate hikes, inflation started to come down. Feds decided at that time to pause the interest rate hikes. They didn't say that we're going to actually start reducing it. They said we're just going to pause it. So when they announced that they're going to pause interest rate hikes, then the money actually started leaving US bonds and they started to pour into gold. So US stock market and gold all started to recover at that time, because again, so there was this whole lot of money that was sitting in USDs. It moved into the stock market and moved into gold. So ever since then, along with what happened in 2022 where the Russia's assets were frozen, notice this is the yellow line that at the bottom represents gold. Gold slowly started to go up. Now, in 2024, which was just last year, Feds kept the interest rates steady. They did not change. It was sitting at 5.25 to 5.5%, right? So they didn't move it until later. So they didn't move it. Inflation did not come down to 2% that they were hoping, but it did come down noticeably from 9% all the way down to 2.5 to about 3.5%. And what that did was that while the inflation came down, it did not remain at dangerous levels. So stock market at that time, because inflation was not at dangerous levels, the stock market carried on doing well. Global financial institutions, on the other hand, continued to accumulate gold because there was a lot of uncertainty in the market. What was the uncertainty in the market? Well, the Russia-Ukraine was going on, conflicts going on all over the world. And around this time, Trump had also come in, and Trump had also started to signal that he was going to do things that could also add volatility in the market. So institutions carried on accumulating gold, and gold prices continued to go up. Then in 2025, when Donald Trump came in, well, he proposed his tariffs. And one of the biggest tariffs that affected the market was the 60% tariff on China. What this did was, at this point, dollars started to go down because interest rates had started to go down. So when US Federal Reserve said that we're going to start reducing interest rates, that's when also money again carried on moving out of the US dollars and into gold. So that was also a time right here. If you notice, the US dollars value started to significantly go down. Now, this was one of the tailwinds for the continuous performance of the stock market. So notice soon after that, the stock market jumped up. Why? Because a lot of multinationals that do business in other countries, they sell in US dollars, right? Now their products start to become cheap in other countries. So their revenue went up. And because when the revenue goes up, obviously the profit has a direct correlation with that. Then the fair market value of those companies goes up. And when the fair market value of the companies goes up, that's where the stock of that company also follows suit. So consequently, one of the tailwinds of the stock market's growth was that the US dollar went down, and then a whole bunch of other things that Donald Trump had said that he would do. For example, accelerated depreciation. He was starting to invest or create these opportunities for young people in the US to create investment accounts for them. There was also dovish indication by the feds that they're going to start reducing interest rates. So money is going to start becoming more easily available. So all that kind of acted as a tailwind for the stock market to go up. But because the US dollar continued to go down, the gold also continued to go up, in addition to the fact that there was uncertainty in the market. So these are some of the things I want to bring to you of what's been happening so far. So as of now, inflation continues to remain sticky. Feds have cut interest rates. Obviously, on September 17th, they cut, and there is a dovish outlook in the near future that they will continue to bring the rates down. As the rates continue to go down, what happens is the short-term interest rates related to money market funds also go down, making that investment opportunity, which is the money market funds, less attractive. And when they become less attractive, well, that money then starts to move elsewhere. So gold continues to have that tailwind that can continue to help give it an upward pressure, to say the least. Now, let's talk about what many people are now calling the starting gun for the modern gold rush. And that was in 2022, the Russian sanctions that were placed by European Union, Canada, United States, and Japan. So what happened was when Russia invaded Ukraine, the West didn't just sanction their banks, they actually froze $300 billion of Russian central bank's reserves. So here's a chart that shows that most of the reserves were held by the following countries. So Germany, France, Japan, US, Britain, Canada, and Australia. So all this money was held under these countries. The only thing that was not held or that was not affected by these sanctions was gold that was in Russia and anything that was in China. That did not get affected, but everything else did. That triggered a wake-up call for all of the other institutions around the world. They started thinking that, hey, if we fall out of political favor from these Western countries, then our assets could just be frozen overnight, similar to what happened to Russia. So many countries, especially the emerging markets, began reevaluating their reserves. And what assets stood out at that time? It was gold. There was no kind of counter parity risk. There was no foreign custody risk, but it still had a very strong global acceptance, which is gold. This is when the central banks began buying gold and their purchase of gold heavily accelerated. So from 2022 onwards, gold purchases surpassed 1,000 tons per year, reaching over 36,000 tons by 2025. And that's globally. And this is not just about inflation hedging anymore. This is actually about countries starting to produce or create a geopolitical insurance for themselves. So this move that United States has done, you can see that there are ripple effects and repercussions of it that we're seeing right now. But here's the thing that I want to bring to your attention. So I've already discussed that US dollars value or price has been going down. A whole bunch of countries are starting to buy gold. You must have heard of the concept of dollarization. So if this dollarization is happening, the question is US dollar at a risk of losing its global reserve currency status? And the short answer is no. Or I should say, not anytime soon. You see, as of Q1 2025, which is this year, the US dollar still accounts for 57.74% of the global allocated reserves according to the International Monetary Fund. Yes, it is down from 70% that it used to hold in about early 2000s, but dollar still remains by far the dominant reserve currency, with just the euro being the next, and its accumulation in the world is only 20%. Compare this to almost 60% of the USD. So exact number is 57.4 as of Q1 this year. And also, you may have also heard a lot of talk about BRICS currencies, especially China's yuan, which is RMB, as a potential challenger for the dollar's dominance. Now, if you've been thinking about that, the BRICS currency and that US dollars is going to disappear, well, let me take a closer look with you all. So have a look at this. The Chinese RMB only accounts for how much? Look at this. 2.12%. That's it. It's 2.12% of the global reserves. And while China has made some progress in internationalizing yuan, the capital controls by China still remain in place. What that means is foreign investors cannot easily move the RMB in and out of China, which limits its global usability. Conversely, the convertibility of the yuan also remains very heavily restricted, which means the currency is very tightly managed by the People's Bank of China. So, what about the other countries in BRICS? So, other countries in the BRICS, specifically India, is probably the most prominent among them. Even though India is more open than China, the total rotation or the volume of Indian currency, Indian rupee, there's not that much of it. So Indian rupee is included in this other currency that I have, and that's 4.93%. And this also consists of all other countries other than the ones that are here. So RMB, I mean, China, Canada, Great Britain, Japan, and Europe. Other than that, and US, other than that, all other currencies, including Indian rupee, is part of this 4.93. So realistically, folks, when somebody says that USD might become overtaken by these BRICS currencies or anything else, and that could happen very quickly, I think the wise thing would be to pause and think of these numbers, because that's not what the numbers are telling me. So yes, in the short term, there may be some effect in the US dollars, but for US to lose its global dominance of the USD will take decades. It's not happening anytime soon. So let's keep that in mind, that even though there is an impact on US dollar from their attractiveness and the treasury bills and their interest rates point of views, its dominance continues to remain, and that can be easily proven by the numbers that exist in the world right now. So as long-term investors, how is it that we should be seeing this? Well, as long-term investors, we should recognize that there is a slow evolution. This is not going to be an overnight regime change. If US dollar were to lose its hegemony, it's going to take time. So over the next couple decades, I don't think as investors in the United States, we have to worry. So now let's connect the dots and the recent USD price action. Now, you've also heard, right, that United States dollar's value has been coming down. And there's a reason why I want to talk about this, because all of us are investors in the US, and gold, because we're talking about this today, which is the Diwali special, Gold internationally is actually bought and sold in United States dollars. It's in USD. So the up and down movement of the USD obviously has a huge effect. One of the other reasons why the gold has been increasing, and again, because gold is purchased and sold in USD, since United States dollars value has been going down over the last little while, well, guess what? Gold just has become cheaper for foreign investors. So that's why the foreign investors like, oh, gold is cheap, let's go buy it. So as so many people have been coming because of cheap US dollar, the gold prices have been going up. But I want to put that in perspective because some people may be thinking that, hey, USD has fallen down, so maybe this is the end of USD. No, guys, not really. Let me show you. We do recognize that since late 2022, right here. So this is 2023, right? Since late 2022, we know that the US dollar has been going down. Now, it has come down, obviously, and I mentioned that the gold historically has an inverse relationship with the stock market. So if I take you back to this specific slide, let's also look at late 2022. This is 2023. Look, late 2022, check out what happened. The gold price has been going up. And if I fast forward to this specific slide, check it out. Late 2022, the US dollar started to go down. Think about what's happening. Because gold is bought and sold in United States dollars, as USD starts to go down, well, guess what? Gold just becomes that much more attractive. Now, couple that with, you know, Russian assets being frozen, and there are problems happening in the world. It's a perfect storm for gold to grow. But what I want to bring to your attention is the falling down of USD a major problem, and is it going to continue going down? Well, ultimately, as you know, nobody knows the future. But if I were to do some technical analysis on DXY, which is the dollar index, compare it to rest of the currencies in the world, USD has now found a long-term support, and the long-term support is so good that it has been tested not once, but once, twice, three times. It has been tested four times in the past, making this a strong support. So I had actually shown this exact chart in one of my previous webinars, and ever since then, if you notice, the US dollar has actually gone up. So if US dollar continues its way upward from this point on, making US dollar stronger and stronger, well, guess what? That could become a friction point for gold from doing well. Why? Because as US dollar starts to strengthen, and again, this is not going to happen tomorrow, it's going to take some time, but ultimately, if this technical chart were to hold as it has in the past, if it were to hold, there will come a point where US dollars value is going to re-strengthen. And when it re-strengthens, guess what? The money is going to move away from gold back into the USD. This has happened in the past. And if I take you back to my very first slide, this has happened in the past. Look at this. Gold goes up, and then it's common for it to dip. Look, it went up, then it's common for it to dip. Even here, it went up, and it's common for it to dip. So the dips are not uncommon. And the dips also happen to, they can be fairly significant. So for example, in 1981 to 82, the gold dipped by 45%. From 1980 to 2000, gold dipped by 60%. And in early 2010, when the gold had risen, when it dipped at that time, this dip was 40%. So this does happen, and there is a potential of that repeating again. When it's going to happen, I'll discuss that time frame based on my understanding shortly. Now, let's look back on the stock market. What has been in favor of stock market, even though the US dollar has been coming down? So number one, corporate earnings have been very strong. So the Q3 earnings season has just started, and many companies have come in. So far, the Q3 earnings season has been pretty nice, but the Q1, Q2 are really, really good. So that's one of the reasons. When the earnings are good, it increases, basically shows the profitability has gone up. Therefore, the intrinsic value goes up. When the intrinsic value goes up, the stock market ultimately, comes up to that point. So that's one thing. Other is the dovish view of the Feds. This is the United States Federal Reserve. So US Federal Reserve is saying that, hey, we're not going to continue increasing interest rates. In fact, on the 17th of September, or around that, US did their first rate cuts. And now there are conversations about more rate cuts happening. In fact, there are supposed to be six to seven all the way till the end of 2026. And I have a slide I'm going to discuss that about that too very soon. So rate cuts expectations are happening. That brings the short-term interest rates down, which immediately affects the money market funds. Now, as the short-term interest rates come down, that makes short-term loans cheaper. And short-term loans or line of credits is exactly what businesses take who depend on loans. So therefore, as money becomes easier to get by companies, it increases their spending, and the expectation is that could lead to growth and profitability, and therefore the stock market also has a positive impact because of that. So in essence, a rate cut expectation leads to liquidity. And the second is so far the US dollar has been weak, which makes the price of multinationals doing their business overseas that much more attractive, making the stocks of those companies that much more valuable in the future. So where are we? We are actually in a crossroad. Dollar is still a dominant player in the world, but if and as it strengthens significantly, and I think it's going to strengthen from this point onwards, that can cap gold's momentum. It can also slow down export driven earnings, and that can add some risks to some of the assets. But I think there are, because of the dovish nature of Fed's liquidity, those are continuing to add an upward pressure in the stock market as well. So here's a broader picture across multiple assets over the last 15 years. So again, we've been talking about gold. Everybody's been thinking that, hey, if I did not buy gold, did I miss out? So I wanted to put this in perspective for you. So this chart shows you the performance of S&P 500, NASDAQ, along with the precious metals such as gold, palladium, silver, and platinum. Notice, since 15 years, and this is not stuff that I've made up. These are publicly available charts that you can also access. So check this out. So ever since 2010, so check it out. Ever since 2010, gold has given a handsome return of 232%, right? Very nice. And most of that return has actually happened only very recently. But compare that to S&P 500. S&P 500 over the last 15 years has grown by 471%, whereas Nasdaq, which is predominantly tech companies, have grown by 1199%. What does that tell you? That tells you that people who have invested in the markets have done much better than a person who only invested in gold. Now, why is that the case? The reason is that the precious metals are governed by supply and demand. These are what I call non-productive assets. So those of you who've been following me for some time, I have spoken about this in the past. So gold is a non-productive asset, which means if you have a gold ring, it's not going to make more rings, right? A gold ring is going to remain a gold ring after 20 years as well. Whereas if you have, an I guess here's my Apple. So if you have an Apple stock, well, what Apple is doing is it continues to manufacture Apple phones. Or if you have Microsoft, Microsoft continues to manufacture Microsoft software, and they continue to keep selling it. So that company keeps producing more, and hence they're called productive assets. Gold, on the other hand, is not a productive asset. So that's where, if you see that the performance of S&P 500, which means companies inside of it, have done much better than gold, well, this is the reason. Now, what I want to do is, there has been also a lot of talk about gold doing very well over the last, just 2-3 years. So what I've done is I've taken the performance of gold and superimpose it with the performance of the Mega 7 or the Magnificent 7. But in this Magnificent 7, I have not included NVIDIA because I'm going to include that in the next slide. But I wanted to show you again, and this is specific for those people who may be feeling a fear of missing out, that they did not invest in gold, right? Since 2021, this is only 4 years ago, here is gold. So gold has returned 120.76%, little more than doubled in the last few years. But check out what's happened to some of the other companies in the Magnificent Seven. Microsoft has had better return than that, which is at 139%, Meta at 160%, and Google at 177%. The only companies in the Magnificent Seven other than Nvidia that have not done as good as well as gold is Tesla, Apple, and Amazon. So yet they have actually produced fairly good returns. So Amazon being the lowest of them as of yesterday had produced 39.69%, Apple 101, and Tesla at 110%. Now, what I want to do now is add Nvidia to it. Again, this is to show those people who may be feeling a FOMO. So check this out, guys. While others such as Microsoft, Meta, and Google, did handsomely better than gold, Nvidia was just in a league of itself. 1,303% since 2021. So, it's not wise for any of us to put all our money in one stock. It's wise to have a diversification. Even members of our community who've been listening and watching us, you'll notice that you may have gold, but gold will be just one of your investments. Now, similarly, if your investments were in some of the other productive assets and you may not have had gold, well, your overall portfolio might still be doing just fine. So this was what I wanted to share here. Now, where do we think we are going forward? Or at least I should say, where do we think we are going forward according to me? So we know that gold rally over the past year has been supported by two major forces. Number one, a weaker US dollar, and number two, lower interest rate expectations, right? Both of those make gold more attractive. When interest rates are low, the opportunity cost of owning gold goes up because you get potentially gold makes you more money. And when the US dollar weakens, gold becomes cheaper for foreign buyers, boosting global demand. But this setup is not going to last forever. So if you look at the chart on the left that I have, and this is a chart that I have shown in the past as well, it shows you rate cut expectations. So as of 27th of August, there was a research done by Carson's group and things that have been happening in the Feds. So the understanding here was that Feds are expected to reduce their interest rates by about 6 times all the way in 2026. So bringing it from 3.77% all the way to 2.97%. Okay, so 6 cuts are going to happen. After that, the interest rates are expected to start increasing again. Why? Because as the interest rates fall down, the expectation is that the inflation might start to go up again. To curb that, the Feds have planned to increase interest rates. When they increase the interest rates, guess what happens? The short term yields increase. And when they increase, the money market funds become more attractive. And when they become more attractive, well, that's where people start pouring in money into the money market funds or short term treasuries for that matter. That money can come from gold, making gold less attractive. Now, when could that happen? Well, certainly when interest rates start to go up, there's a potential of that happening. But stock market actually behaves even before things happen. So it starts to behave in anticipation of things. So, for example, when I showed you earlier that gold had started to go up, when there was an indication that Feds would stop increasing interest rates, right? They hadn't started decreasing it. They had just hinted that we're not going to increase it. When they hinted that, money started to flow into gold. Similarly, as we move forward and investors start to believe that the Feds are going to start increasing interest rates again, well, guess what? That's when there's an expectation of money to start moving away from gold. Other thing is the US dollar. So as US dollar strengthens, well, that is a byproduct of the interest rates increasing. So as interest rates start to increase, or the anticipation that the interest rates are going to increase, well, that's going to start making the USD more expensive. And that's also going to be a catalyst into the gold starting to go down. Now, when do I think this is going to happen? I think there is a possibility of gold starting to go down sometime in 2026, if not in 2027. This to me seems like the time when the gold is going to the headwinds that are pushing towards gold are going to start showing up. Now, is that really going to happen? Ultimately, nobody has a crystal ball, and I also don't have a crystal ball. So we're going to wait and watch. So, I want to take a moment to talk about the performance of precious metals over the last 15 years. And this is not just gold, I want to talk about all of them. So, here is a chart that I have that compares it against S&P 500 so we can anchor against something. But it's got gold, it's got palladium, silver, and platinum. And I'm going to tell you what all these are, starting with just quickly S&P 500. So we know that S&P 500 since the year 2020 has produced 507% return. This has outpaced all precious metals and by a large margin. What are the reasons? Well, it's driven by tech sector dominance, low interest rates, high corporate profile and innovation cycles, and ultimately the takeaway here is that equities remain strong long-term winners unless inflation, currency devaluation, or global crisis shift capital into other kinds of hard assets. Second is gold. So, gold over the last 15 years has been up by 261%. And we know that the primary use of gold is that it's a store of value. People just park money in it. Unlike other metals, gold is not heavily used in industry. It's mainly held by central banks, such as ETFs, and individuals for their wealth preservation purposes. It certainly shines in the time of inflation fears, currency devaluation, or any kind of geopolitical risks. Key drivers that make it grow are actually not retail investors. They're actually central banks and their demands, or weak dollar or low interest rates. Future outlook, I think gold is going to continue increasing if interest rates continue to stay low or continue to go down, and also the US dollar continues to weaken. When this pauses, which means US dollar strengthens or the real interest rates rise, that is going to start pausing the growth of gold. Other is silver. So silver has been up by 192.22% over the last 15 years. So roughly 50% of industrial use it, or its use is 50% industrial and 50% for investments. It's used in solar panels, it's used in semiconductors, it's used in electrical vehicles and even medical technology. Often silver is called the little cousin of gold, and it moves in a similar fashion to gold, but it's more volatile than gold. And why is it rising now? Well, it's rising because of industrial use. It's also rising because gold is rising. So people are like, let's put money in silver if I can't afford gold. And AI and data centers, as they're being built, silver is used in them because silver is a very good conductor of electricity. Its future outlook, well, it has a strong upside if technical infrastructure or technology infrastructure continues to utilize it and green energy continues to scale. Next is palladium. So its primary use is in automobiles, specifically when it comes to the catalytic converters in gasoline engines. So catalytic converter is something that reduces those emissions, right? So every car has to have those. It ultimately reduces the emissions, especially used in China, Europe, US, and Canada. My cars have catalytic converters in them. Now, not many people talk about palladium, but it has had a huge bull run from 2016 all the way to 2021 because of strict emission regulations. But now it's under pressure because electric vehicles don't use catalytic converters because there are no emissions coming out of this. My future outlook for this is that palladium could remain under pressure unless demands shift back again into normal vehicles. But it's still valuable in the auto industry and possibly hydrogen fuel cells. Electric vehicles are coming in, but conventional cars are not disappearing overnight. Next, platinum. So platinum's used, yes, it's used in jewelry, but did you know it's actually used in diesel vehicles, catalytic converters, and any kind of chemical refining that happens? This lags behind the performance of gold, palladium, and silver because less investors are interested in this compared to what they're interested in gold and silver. And future outlook is that if green hydrogen adoption increases or palladium demand could return because of diesel engine demands, then this could go up because diesel engine demand has actually been declining over the last little while. So folks, I hope this was useful. And this gives you more perspective on where gold is, why it has been going up, and what you can do with it. Thank you so much. Happy Diwali to you all.